Welcome to Wealth Matters Podcast. This is your host Alpesh Parmar. Today I want to discuss about retirement plans, and this would be specific to US of A, United States of America, but I'm pretty sure most of the countries in the world have similar kind of retirement plans. And so I do want to discuss about each of the retirement plans and how they work. So, probably one of the main reasons why people work hard is to enjoy life and retire comfortably. The idea of relaxing at your own home without worrying about finance it in your 60s, 70s sounds like heaven, right? Some people save money and plan for their retirement as early as they can, but saving for retirement is not a thing that fits for all their all in the same circumstances. Every situation and every goal are unique to one another, right? So, thus, it is important to look for the right retirement plan that will best suit your needs and goals. Of course, when I talk about retirement plan, there used to be a pension plan before, and now it's almost replaced in most of the places with 401k plan, right? So how can we not start with 401k plan? So 401k is a workplace retirement account that is offered as an employee benefit. I'm not sure if it's a benefit or not. Yes, if you are getting some kind of match, 50%, 25, I've heard, some businesses even giving 100% match, then I would say it's a benefit. Otherwise, I'm not sure, other than it's forcing you to put stash money away, which you cannot touch or control. But this type of account allows you to contribute a portion of your pre-tax paycheck to tax-deferred investments. So how does it work? If you are under 50 years old, the IRS allows you to contribute up to 19,500 to a 401k. On the other hand, if you are older than 50, you can put up to 26 grand every year in the account. There are also some instances where your employer, as I said, may match a certain portion of your contributions. The amount contributed to a 401k is deducted from your taxable income. You will then need to start taking withdrawals from the account starting at age 70 and a half. This is referred to as the required minimum distribution, or you may have heard RMD. When funds are withdrawn, they are subject to taxes. If you take money out of the account before age 59 and a half, you may face penalties. So as you can tell, there are way too many, uh, you know, uh, regulations, restrictions, rate tab, as well as control, measurements around this plan. And this is why personally, I'm not a fan of any kind of retirement plan because I can touch it. I have to start taking distribution when they ask me to, only RMD, as I mentioned earlier. Um, and I don't have control on my money because I can only invest in the things which are offered through my employer or maybe through that particular, um, you know, uh, IRA custodian, right? So, or 401k custodian like Vanguard, it could be JP Morgan Chase, Merrill Lynch, etc., etc. But some of the pros offers financial security opportunities to employers. Contributions are easy to make through payroll deductions, so you set it and forget it. Employee contributions can reduce current taxable income, and this is the main reason why businesses as well as CPAs and a lot of other people promote 401k or other type of retirement plans. That, oh yeah, right now if you are making 100 grand or let's say 200 grand, you're stashing away 19,500 or 26,000 will allow you to reduce your tax bracket, and so in turn you will pay less taxes. But when I start taking required minimum distributions, I got to start paying taxes on that. So there are pros and cons because the way I look at it, when I start taking distributions, should I be paying tax on the seed or the harvest, right? Because if my money would have grown in 30 years, of course I would have a lot more in that account. So some of the cons, right? Forced withdrawals. You will be forced to withdraw money. when you reach a certain age, as I mentioned, right? Long waiting periods. Generally, the waiting period at an employer are long before you can begin to contribute sometimes, right? Employer limitations. Some of the employers may not allow employees to contribute as much as they would like to. And of course, no control. The next one is so 401k offered through job, but of course, there are other ways for you to continue to invest or stash away money in retirement plan. Is it's called individual retirement account, IRA. And IRAs are two types, traditional and Roth IRA. We'll talk about traditional IRA right now. It's also tax favored account. You can use this account to invest in stocks, bonds, ETFs, etc. Um, and basically, this will be on top of your 401k, right? So let's say you had you want to put up to $2,000 into the account, but the contribution limit for an IRA is $6,000 in 2020 and 7,000 if you are 50 or older, right? So basically, on top of the 401k, you can stash away up to $6,000 every year, and you should be able to deduct that money from your taxable income. But again, that also starts phasing out, and I'm in San Francisco Bay Area, where it's the IRA phases out for almost everyone, right? So some of the pros, deductible contributions, right? Because I can just deduct all of my, investment into IRA from my taxable income. Tax deferred growth, same as 401k, that it's growing tax deferred. Anyone can contribute as long as they have earned some kind of earnings. And contributors have some control, right? So this is, I would say, little better than 401k, because you can open it to with any bank, and you can start using it to invest the way you want. Again, when I say the way you want, it means only in Wall Street, in stock market, bond, ETF, etc. Cons, lower contribution limit, right? Because the contribution limit is very small. So if you don't have 401k, you have only up to 6,000 or 7,000 if you are above 40. And same thing, early withdrawal penalties apply. Roth IRA is one of the retirement plan which I like, because this allows you to actually put money away. You pay taxes on it, but basically you don't pay any tax on the harvest. So I always ask people, do you want to pay tax on the seed or the harvest, right? Means I would not want to pay tax on my harvest, because that would be the bigger account, just with compounding interest, etc., and inflation. So Roth IRA is just like the opposite of traditional IRA, right? As I said, because contributions are made with after tax dollars, and uh, any money generated within the Roth IRA will never be taxed. So this is the amazing part of it. And You are also not required to begin taking withdrawals at age 70 and a half. So that's amazing also. So pros of Roth IRA: the savings are tax free, no minimum distributions required, it's easy to withdraw contributions at any time, you get tax diversification. Cons: you pay taxes upfront. So I say, you got to pay up taxes now or later. What would you want to choose, right? The maximum contribution is also pretty low, and you have to set it up by yourself. There is another IRA, and again, so the first three IRAs we spoke about are the retirement plan, 401k, traditional Roth, apply to employees, right? And the next ones, if you are self-employed, if you own a business, etc., then you could look into some of these, different IRAs available for self-employed, because they don't have employees or employer. Basically, they are their own employer. So the first one is simple IRA. The simple IRA, basically, it's savings incentive match for employees. IRA is a retirement plan for employees who work at small businesses with up to 100 employees. It exactly works like a 401k. To qualify in a simple IRA, you will need to have earned at least $5,000 from the company during the previous 2 years, and also be expected to receive at least $5,000 in the current year. Through this account, you'll be able to contribute up to 13,500 in 2020, If you are age 50 or older, you can make additional catch-up contribution of 3,000. In addition, employees are required to make contributions to the account. So pros of simple IRA: can be easily maintained. It's exclusive for small businesses. Cons: there is a large penalty when cashing out before the retirement age. It can go as high as 25%. Now, this is the next one is what I have also, and I have another account as well, and I'll talk about both and what's the difference. So, uh, simple IRA the limit is too low. So, if you are making good chunk of money and if you want to stash away, then look into SAP IRA. It's called Simplified Employee Pension Plan IRA, right? So, basically, say exact same things like simple IRA or 401k. You can contribute. If you are eligible for SAP IRA, you'll be able to set aside up to either 25% of your compensation or 57,000 is the maximum in 2020, right? So that's amazing. But you can only do whatever is less, right? So let's say you made 200,000 in 2020. You can't just stash away 57,000. You have to see what is less. Is 25% of 200 grand less or 57,000? So uh, that 25% of 200 grand is 50 grand, right? So that's what you are able to contribute. So if you compare now this to 401k or traditional IRA, the limit is amazing, right? So if someone really wants to build their account, retirement account, SEP IRA it's great as long as you are self-employed. You got to have a business, right? And that business should be running your payroll, should be paying you at the salary as well. So I had done this for some time as well. And then I decided I don't want to start, even have a running that much payroll to just be able to contribute to this IRA. Again, it's same. You have to take withdrawal starting at 70 and half. Some of the pros, all earnings accumulate with no immediate income tax obligations, right? So you can change investment without tax liabilities. The contribution limit is high. Cons: no catch-up contributions. Because the regular contribution limits are so high, so employers who are 50 and over cannot make catch-up distributions or contributions, sorry. No loans or Roth contributions. So basically all contributions are made on a pre-tax basis and taxable on withdrawal, and savings cannot be borrowed for other uses before retirement age. SAP IRAs are funded entirely by employer contributions. The next one, solo 401k. So I have this as well. And I would say solo 401k and SAP IRA are almost exactly similar. I don't see much difference, right? Solo 401k also is for self-employed. If given a choice between SAP and solo, I'll go with solo because of this. I have full control of my money. I can invest in any type of assets and not just stock market or Wall Street. SEP IRA gives me almost full control, but it's not exactly a solo 401k. And the reason I'm saying this is my personal experience, and I have both the accounts right now. I started with SEP IRA. Once I learned about solo 401k, I pretty much moved half of my retirement portfolio to solo 401k. With SEP IRA, you can open an account with Chase, Bank of America, Merrill Lynch, etc., Wells Fargo, whoever offers IRA, as well as you can, just move it to a self-directed IRA, and we'll talk about that as well, to a custodian, IRA custodian like UDirect, Quest, self-directed IRA services, etc., right? But without that, if I just I'm comparing SAP to solo, with solo 401k, I have a bank account. I have direct control of that bank account. I have a checkbook, so I can pretty much invest my money wherever I want. So those are the things about all different IRAs or retirement accounts available, and we'll discuss about self-directed IRA next. I'm going to take a quick break and talk about Wealth Matters podcast. This podcast is for people who want to build long-term wealth, who want to generate passive income. And if you like my YouTube channel, or if you are listening on iTunes or any other podcast platform, please, I'll be grateful if you can subscribe to my podcast, or on your YouTube channel, if you can share this podcast or the YouTube video, as well as if you can leave a review for my YouTube video, like same thing on iTunes. If you can leave a review, then a lot more people can find out about my YouTube channel as well as the podcast, and I'll be able to attract even better guests for my podcast. And the second thing I'm doing, I have decided never to sponsor my podcast or YouTube channel, so I'm not going to market you. I'm just running this podcast and YouTube channel on my own. My goal is to provide quality content, so I'll be very appreciative if you can share, like, subscribe, and leave a review on YouTube as well as iTunes. Thank you so much. Okay, let's talk about self-directed IRA, as I mentioned right before we took a break. So self-directed IRA, as the name suggests, means you can direct where your money is going. And this is why I, would prefer self-directed IRA over 401k, over SEP IRA, over traditional Roth, any kind of IRA. And again, self-directed IRA could be applied to your traditional Roth, any of SEP IRA as well, right? So basically, that means that instead of you going to a big bank, you are going to a small custodian. As I mentioned earlier, there are so many. If you want to know more about it, definitely reach out to me, email me, and I'll be able to help you. So STIRA is exactly same as Solo 401k. You can get a checkbook control. You can just write check. You can invest money in of course stock, which you are doing. So I'm not going to talk about. I want to talk about the alternative assets. Like main one where I invest personally is real estate, right? So you can actually invest in a passive syndications. You can buy a coffee farm or agriculture the parcels, like I have done with my Solo 401k fund. You can buy gold, you can buy Bitcoin, cryptos, etc. So it's the possibilities are endless, right? And so basically STIRA is for employees who want same control as employers like me are getting through Solo 401k, right? So basically Solo requires you to have business, and STIRA or self-directed IRA does not require you to have business, and it still gives you same control, right? uh, the only advantage of Solo 401k over self-directed IRA would be one, that no UBIT or UDFI to worry about. This is the tax you'll have to pay if you invest in a leveraged real estate. When I say leveraged real estate, means any real estate property you acquire, usually you get a loan on it, right? So if you use your IRA money to invest in a leveraged real estate, you may have to end up pay taxes when that property is sold. So that's where I would prefer to have Solo 401k over self-directed IRA. Otherwise, you can pretty much invest in all kind of assets available, other than art, life insurance, etc. That no retirement plan allows you to invest in those kind of assets. So I would highly recommend people to look into self-directed IRA right now. Also, and the reason I decided to do this podcast was some of the provisions I saw in the CARES Act regarding 401k. So, and I heard some of the people are taking advantage of it. So this year, you can actually take, and again, I'm not an attorney, I'm not a CPA, so please take this with grain of salt. I'm just talking from my experience about all of this. So please do not reach out to me saying, oh, I was not able to do this, right? But in 401k for World, you are able to take a loan up to, I think, 100k this year, and you can pay it back within next 3 years. So basically you can take a loan, invest money somewhere, and then pay it back within 3 years. Or I have seen people do that where they are, of course, you are not able to take advantage of certain provisions, but you can convert. So 401k, once you are in 401k, that money is locked, right? And unless you switch employers, you cannot take that money out. But this 100k provision from CARES Act will allow you to take that money as loan, And you can basically go after a month, you can go to a custodian, IRA custodian, open a self-directed IRA, and then you can just do again an in-kind rollover, because as if you are paying back to your 401k, right? And this is, of course, you have to show that you are affected by COVID-19, but I would recommend that you reach out to your 401k custodian, talk to your attorney or NCP and or CPA and figure this out. But remember, if you can pull this off, 50k, 100k, that money you can fully control. Now, even though there are restrictions on taking distributions, but you can pretty much invest wherever you want. So basically now you are truly diversifying, right? If you are already investing on your own in stocks, you have 401k which is in stocks or Wall Street, remember, just look at your overall portfolio and figure out how much exposure you have to the stock market. Of course, right now everyone is happy that, oh yeah, stock market's up like 20-25% since March of 2020, but things could change, things can get ugly, and I would always prefer to have diversification in my portfolio. So I'll highly recommend check out self-directed IRA if you, and see if you can convert your money from 401k to self-directed IRA. So I have mentioned this before as well in my newsletter. And if you have not subscribed to my newsletter, please visit www.wealthmatters.com. It's spelled as WEALTHMATRS.com, and subscribe to my weekly newsletter where I always discuss about different opportunities, from of course real estate, self-storage, mobile home parks, etc., to life insurance, to agriculture. And I will make sure I'm not spamming you. And if you ever feel that I'm spamming, then please go ahead and unsubscribe yourself. But this is the excerpt I'm gonna take from one of my newsletter, right? Where I mentioned why I don't like 401k, IRA account, or any other retirement plan. And this is just my opinion. You may think something else, right? But these are some of the reasons. So we have been told our tax rate will go down. In reality, the opposite might be true. Even though you are not working, you will be pulling money out of 401k, IRA, etc., which is taxable unless you have Roth IRA or Roth 401k. So I think I did not talk about Roth 401k. It's basically solo 401k, and you can convert it to Roth 401k, right? So by default, solo is a traditional 401k like traditional IRA, but you can have it as Roth 401k. One of your biggest tax deduction for mortgage interest could disappear if you have paid down your mortgage. This will also increase your tax liability. And who would want to be poor when they retire? I don't want to. I want to make same amount of money when I retire. So if I'm doing that, my tax rate is not going to go down. By putting money in a QRP, qualified retirement plan, you are losing control of your money, as I mentioned. Even though it's your money, you can't actually use it while others are profiting from it. You have to follow your employers and the government's rule on when you can and can't, what you can and can't do with your money, right? So, for example, you can only start taking money out after you turn 59 and a half, even if you don't want. You must start taking RMD at age of 70 and a half, right? Or 72. It also means that you will get hit the hardest if you have to withdraw money in a down market. Deferring taxes in a qualified plans means that you will pay taxes on the harvest rather than just the seed. This is what I have mentioned before, because this strategy psychologically fools investors into thinking that they have more than they really do, because a good portion of the money in your retirement account will go to pay future taxes and management fees. Target date funds are a big mess. Like December 2007, after 14 months of heavy lobbying of Congress, the Pension Protection Act authorizes employers to place employees' qualified plan savings in target date fund as a default option if an employee does not choose otherwise. So if you don't choose anything, it goes in the target date fund. And target date funds are comprised mostly of stock, replace stable value funds. as a default option, right? So let's an example: participants in the 2010 retirement funds, that was the target fund. People who intended to retire in next year or two lost substantial. The bulk of many target date funds were still in the stock market even as retirement dates approached or passed, thus failing to protect investors' retirement funds. As assets grow, so do fees, right? That's how Wall Street works. Fees are paid whether or not the investor is winning or losing in the market. This is also very important. It does not matter if you make money or not, you still got to pay the fees. Qualified retirement plans make poor saving vehicle for savings. They subject money to risks, put it behind a tax wall, and tie dollars up where they cannot be used. Investment options are limited in qualified plans. This is one of my biggest, scribe, right? That gripe that I can't, control my money where I want to invest. And the next portion, I took it from Kim D. Butler's book, Life Insurance, Live Your Life as Life Insurance Style. So, like ways to control your wealth include avoiding speculation and trying to time the markets, limiting 401k or other qualified plan contributions to amount required for the employer match, right? Yes, lots of my friends tell me that they want to keep putting money in 401k because they get a match. Oh yeah, of course you should not let go of that match, right? That's pretty significant amount of free money. Why would you let it go? But yeah, personally, I will put that I'll only invest up to the match. And if I really want to still do for a retirement plan, I'll use Roth rather than traditional IRAs and 401ks. This is some of my thinking or my opinions. As I said, please do your own due diligence. Do reach out to me. I have a couple of opportunities right now. I'm still looking at senior housing, which we are closing soon, and a mobile home park. And I keep looking, evaluating other deals as well. I would love to help you guys out. So please do email me or call me. Take care.